Hi, this is Ron Rowland from Money and Markets TV. Exchange-traded funds almost always perform the way they should, but they may not always perform the way you expect. To understand the difference, you first have to know that the vast majority of ETFs are designed to follow an index. For the benchmark S&P 500 index, the oldest and largest associated ETF is the SPDR S&P 500, symbol SPY. For any time period you choose, you'll find that SPY follows the S&P 500 with laser-like precision. And this is the case for most funds. There's usually very little tracking error. Where things get a little more complicated is with leveraged ETFs, such as the ProShares Ultra Pro S&P 500, symbol UPRO. It's designed to move 3% for every 1% change in the S&P 500. From July 2011 to the end of last month, both the S&P 500 and SPY rose about 2.8%. Since UPRO has built-in 3 times leverage, you might expect its gain to be 8.4%. But it actually fell 9.5%. So, what happened? Did something go wrong? No. Investors just misunderstood how leveraged ETFs work. The fact is, the leverage factor resets every day. So, the longer you hold an ETF like UPRO, the less the design leverage matches the underlying index. That's why these ETFs are useful only for short-term trading. A similar disconnect can happen with inverse ETFs. On the surface, they seem simple. If the benchmark drops 10%, the inverse ETF should go up 10%, right? Not so fast. That's only true on the first day you own it. Just as with leveraged ETFs, the inverse mechanism gets reset every day, so their performance becomes more and more unpredictable the longer you hold them. Now, don't get me wrong. I'm not telling you to avoid leveraged and inverse ETFs. I'm just making sure that you completely understand what you'll be getting from those types of investments before you jump in. ProShares and other sponsors also do what they can to educate investors about the full impact of daily resets. Keep in mind that every tool has its limitations. The fact that a hammer doesn't turn screws very well does not make it a bad hammer. It just means you need a different tool. Leveraged ETFs and inverse ETFs with daily resets are great tools when you want to make a short-term bet. But if you stick around more than a few days, you may not get the results you expect. In the end, you're the one who makes the call. Keep the right tools in your belt and you'll probably do just fine. I'm Ron Rowland from Money and Markets TV. Thanks for watching.